All right, this is a kind of a great tutorial, especially since it's live and before the event happens, we'll find out how the trade works out. But this is Fastly. They have earnings on the 12th. And so what we're looking at is a stock with a weekly pattern that looks pretty powerful. You could argue it is a shoulder head shoulder with a neckline breakout, came back, tested the neckline, and is bouncing higher. If you're looking at that type of objective, then the measuring objective is back to 13. Implied movement on this stock is about $1.90, and it's already, as you can see, up 6% or so up 60 cents today. So they're looking for a dollar. Well, you can expect if it meets the $1.90 implied move, that would give it another $1.30. $1.30 plus 1070 is what? Well, it's $12. So you got pivots up here. The monthly pivot resistance is 1249. So, if you really like this stock and you think that Fastly, which is in cloud computing sector, which is really hot right now, of course, with AI, and then you take a look at the daily charts and say, well, let's see, we're above pivot. We're generating a daily PPS buy, but earnings are coming out this week. Volume momentum is looking a little improving here. The relative strength, PMC is outperforming, so it's got a few good check marks to say, boy, this has some upside potential. If you like the space and you like the stock longer term, and you think that maybe perhaps this could be the time that we could get back up into this year, and you want to go with more of a position trade rather than just a simple gamble option earnings play, here's how you could take and utilize options and manage risk. So for that, let's just take a simple trade. We're going to buy just 100 shares of this stock. Fastly, it's a $10 stock, so it's not a big deal. It's not going to require a lot of equity. And so basically, let's talk about, before we hit that buy order, let's look at the overall options market. So for this week, as you can see, earnings out on the 12th. So we drop this down. We say, is there anyone else that feels that this is an exciting stock to trade? Well, on the $10 strike calls that expire this week, it looks like 4,800 volume against 500 open interest. So that means there's new trades going on today relative than before. Now you look on the put side and you go, well, that's interesting. The 10.5 are in the money options. Open interest here in this column, 76, and that'd be perplexing. Except for someone's uber bullish, they sell in the money calls, and they sell probably added to the option strategy. And if you look at this, 2 plus 1 is 3. So that's about what, 3,800, close to 4,000. 4,000 puts were traded that are kind of in the money, right? They're 1073, so they're both in the money. And maybe they use that fund to buy an upside call. So this would be what we call a potential risk reversal potential. The other strategy I would employ is, if I was going to buy the stock and not play earnings outright, is I would just go and try to buy the stock 1074, review, hit the send order, and again, we're filled. All right, now what do I do? I'm into this trade. I think it's still a good trade, and if we're going to see some upside move, I would want to maybe implement a collar strategy and say, well, maybe the stock is good longer term, but what if over the next week it only goes so far? And so I would want downside protection in case I'm dead wrong. How do I do a collar strategy? So if I'm in at 1075 and you add your $1.30 into the trade price around $12, I can actually sell the $12 call, right? And if I sell that $12 call, I collect 50 cents. I get 50 cents of credit. What would I do there for 50 cents worth of credit? Well, for a 1050 put, it's going to cost me 40 cents for protection. So how does that figure out? If the 1050 put is at 86 cents, and if the $12 call is 51 cents, I'm taking in 50 cents, and what am I doing? I'm paying out 85 cents if I can get filled at that price, and that's the key. You take one side at a time and try to get filled. So bottom line is, I'm just working around the structure of, I like the stock longer term. I think if it does have a blow up to the upside, it would be a loss of profit opportunities. I wouldn't lose money on the trade. I'd make some money on the trade. But in this example, I'm just trying to share, how do you implement a collar strategy? So first and foremost, I want to go with, I'm long the stock, and if I'm long the stock, I want to leg into a spread and I want to take the opposite opposing side second. So the first course of order is you get long. The second course of order, you try to trade around, and I don't want to give them every bit of my money. So let's split it down and see if this is a real bid and ask behind the scenes, so to speak. Let's go with 53 cents and see if that actually changes the offer side of the market. I'm stepping in front of that offer and going 53 cents to see if we get taken. So I send the order, and it's working. Now on this platform, all I have to do is right click, cancel replace, and doesn't matter, I got filled. That was me, 53 cents. Now I got taken in 53 cents of credit. What am I gonna do with that credit? I can do nothing and just be a long stock with a 53 cent cap, which means I'm long at 1074, and I shorted a 12 strike call, collected 53 cents. So that means $12.53 is my max profit potential in that trade. If I'm nervous and I think that the market could maybe stay between this range, and more importantly, maybe it goes down first and just sucks the life out of the stock, I can always take that 53 cents and use it by selling a downside put. And if I do that, that's how you would now take an option. You sell the call, now I need to buy the put. So I'm going to try to go and change this and go to review and send, clear order. Here we go. We are short that. It says short that. Now let me go to the 10.5 strike. Now the 10.5 strike again is more than I sold the option for. So I'm going to actually pay a debit, but I'm going to be very close of a small risk trade on this particular position. So if I go over here and I want to buy this option, I have to click the ask to buy one. And what am I going to do? Am I going to pay any price? No, let's try and go and try to snazzle out 87 cents and split it kind of down the middle and see what happens here. Hit send the order. It's working. You can see W next to it. If you want, just for practical purposes, just to get the order done, let's go a penny and try it again at 88. And it's still working in there. That's us, 88 cents. They're very firm at holding their offer at 91. That would be Citadel or the market maker or the people working behind the scenes of this particular platform with the bid and ask. Replace the order. Let's go with 89, and this is how we do it. Hit send the order, and that's us again. They're going to want that full 90 cents. So that's going to be about 40 cents, 39 cents. We change this order. Here we go. And we don't have to. Got filled. All right, so there it is. So we're completely protected. We're long the stock. We're short a call. And we're long and put, and that's how we execute that order. And then for earnings, if this stock goes up, that's okay. It's a small profit. If the stock doesn't really move, that's great. We're still long a stock we wanted to be in. And number two, if the stock goes down first and it's like the earnings, like they're going out of business, we're completely protected. And if it doesn't do much of anything, our downside insurance cost us 40 cents for being out of the money of 22 cents. See, so for 1072 to 1050 is 22 cents. So the idea of a collar option strategy is to wrap around by using the market's money by selling upside premium to finance downside disaster insurance. So I'm just taking this particular trade to just share with you how to mitigate risk, because no matter what we do in this environment, in this trading community, take a look, GOOG. They were going to be absolutely off the charts bullish, everything breakout, things were looking good. The relative PMC was starting to weaken. It could have gone in an explosive upside move, and guess what? Instead, it gapped lower and just crushed people. Let's take a look at AMZN. Same story. So everyone thought, hey, Amazon, they're just gonna beat, and they did. They beat. The earnings were fabulous. But what happened? Stock went down first and just killed everyone. If you're in a collar strategy, you buy the stock, sell a call, buy a put. The call will go worthless. The put makes money, and you're able to afford to stay with the trade without having a financial disaster. And that's what a collar does, mitigate risk. I hope you enjoyed this video. This is how it's done. Thought I'd walk you through exactly how the thought prospects work. Now we'll see what the outcome of the trade is. Hope this video helped you out to understand how to implement collar option strategies in real time.